Perfect. So the point of today's webinar is really just kind of provide an update on the markets, talk about kind of our portfolios, how they're doing, answer any questions you have about the economy right now and what's happening in the markets, but to really just kind of give you a candid approach to what's happening and what we're doing within our portfolios to help our clients. So we'll go ahead and get started. All right, so the first thing is we started out with this kind of in our last presentation, but the stock market is truly a method to transfer money from the inpatient to the patient, right? So what we saw over the last really 3 months here, 2 to 3 months, has been a lot of anxiety in the markets. The media, right, just racking up their own growth by creating a lot of fear in the world, right, in our lives. And with that 24/7 news cycle, questioning what we're doing. And so what we want to do is kind of follow the evidence. And we stayed patient, right? We kind of talked to our clients about, hey, we've seen this before. These things are going to happen. We need to continue to stay the course. And if we do that, then we will essentially capture a lot of the permanent transfer of wealth that's happening as people sell low and try to buy high. All right, so what we showed is in this slide, a balanced portfolio of about 60% stocks, 40% fixed income, looking over that 2018 timeframe. And if you'll remember, fourth quarter 2018, Trump and the administration kind of launched a trade war against China. The markets didn't respond, positively. Additionally, the Fed said, hey, let's try raising the interest rate. All of that led to a near recession, fourth quarter 2018. And so if you got in the market at 2018 till today, things may not be looking so good because you went through 2 recessions, essentially. Obviously 2018 and then what we're going through right now. However, if you sold at the market low and locked in your losses, it cost you tens of thousands of dollars. If you waited, you sold and waited till you got some positive news and got back into the market, you still lost out. If you just stayed the course, which is what we did here at Bolt Financial Group through 2018 and also through 2020, you will maximize your wealth, right? Transferring money from the inpatient to the patient, right? Here's just kind of a neat graphic. So how does this play out in 2020? So if we look at the S&P 500 through the last year, believe it or not, within the last year, so full 12 months, the S&P is actually positive. So even though we saw a drastic decrease in the market in the March month of 2020, we are positive over the last 12 months in the S&P 500. And I like to talk about the S&P 500. Think about the S&P being the Fortune 500 companies of America. The Dow Jones, which gets kind of spewed a lot on TV, is essentially 30 of the largest stocks out there, blue chip, that pay dividends. It's kind of its own asset class. Developed in 1896. The game has changed, so I recommend following the S&P 500. But know that over the last 12 months, it's actually positive. So we saw a market high, right, an S&P all-time high in mid-February, and then the coronavirus kicked off, and we saw a recession hit, right, an over 20% drop as defined to define a recession. And then March 16th, we hit our all-time low during this recession, and it's been pretty strong since March 16th. And so what we didn't do is we didn't lock in the losses on March 16th. We didn't wait, and then until March 31st, we started getting positive news and buy back in, right? We rode it all the way out, and now we've been able to maximize our return. Now, we're not all in the S&P 500, but this is just kind of a good barometer for how the U.S. economy is doing and all of the kind of the banter that's on TV. So know that over the last 12 months, it really hasn't been that bad, right? It hurt, right? It hurt going through it. And don't think that I'm immune, okay? As this is going through mid-March, I know that I'm managing people's, retirements, their goals, their dreams. And it's hard to make sure that I'm helping people stay the course. That's what keeps me up at night. Always fearing that phone call. Hey, Sean, I really want to sell and run to cash. This is kind of scary. that means I did them disservice by putting in a portfolio that was too risky. And so my goal when we talk with people is I want to find your pain point so I can maximize your return. But if I put you in that if I overextend you in terms of how much we put in stocks versus bonds, and then you decide to sell to cash, that actually hurts you, right? So that's what keeps me up at night. But I know that the market's going to come back, right? It always has. And so we want to stay disciplined throughout the process. All right, so just kind of a market overview. We'll talk about all the different asset classes just to be very informative so that you kind of know where everything stands. S&P 500 is great, but it's only one piece of the puzzle, okay? There's so much more to the world of investing. So I want to warn you, this presentation is a little nerdy, okay? I like it. This is what I live for. I am the nerd, but it may not be as exciting to you, but hopefully it's a little bit informative for you. If you have any questions, we'll have time for those at the end. All right, so how are the markets performing? Okay, so the S&P year to date, just talking January 1st up until yesterday's close, the S&P is down 6%. So again, not as bad as maybe the media makes it out to be. Also, a lot of uncertainty about that number, right? How do we have unbelievably record high unemployment numbers, and yet the market's only down 6%? You know, and we'll go into that, okay, about what's a part of that. The NASDAQ, so think of really your technology companies. Some of those overlap with the S&P 500, but also some companies that are not necessarily Fortune 500 companies. A lot of the tech industries on the NASDAQ up. It's actually positive for the year, up 4%, okay? So another thing that I like to point out is, you know, at Bolt Financial Group and Endeavor Investments, our clients are invested in the NASDAQ. Okay, if you look at your target date retirement funds, 99% of the time they're not even invested in the NASDAQ. Most people off the street, right, or a casual investor, they're not invested in the NASDAQ. Okay, so here's one way that we differentiate ourselves. The reason we do that is because the evidence points to the NASDAQ tends to outperform the S&P over the long term. So know that that's one area that we have in our portfolio that most people don't. And again, there's a reason why. It doesn't necessarily move in direct correlation as the S&P 500 or the US stock market in general, right? It has some different properties that allow it to kind of move in its own direction. Again, it's positive for the year. Okay, so that kind of is all the good news, right? I'd say the rest of the world not doing as well. And so we'll talk about why even have some of these in your portfolio. So outside of the world, right, down about 15% across the globe. U.S. small value, right, really hurting, down about 24%. Again, I would say one of the reasons that we differentiate ourselves is we have a tilt in our portfolios towards small value, right? So people are starting to wonder, why am I even invested in small value and international if the U.S. market's doing so well right now? Okay, we're gonna talk about that. International small companies down about 16%. And emerging markets are down about 17%. Emerging markets, think of like your Chinas, right? Your Indias, kind of some of those developing countries. And then bonds for the year. Okay, so here's a positive, right? Bonds, intermediate treasuries are up 7.15% for the year. International bonds are up 1.33%. U.S. corporate bonds up about 1.81%. U.S. corporate short-term bonds, 1%. Muni bonds up about 0.81%. Global real estate, not necessarily a bond, more kind of fixed income, also kind of an equity, kind of its own unique category, down 24%, right? So one of the things that analysts continue to talk about that may be a lasting effect of the coronavirus is this real estate. So commercial real estate, think of all your companies, you know, working in buildings, so on and so forth, me right now in my office. Will these companies continue to have these increased expenses, this overhead expense, if all of a sudden we just quickly, very, very quickly, I mean, it was truly amazing how fast companies went to hosting Zoom videos like this or Google Meet or whatever your flavor is, but now conducting business without having the huge overhead expense. So will business continue to invest in one of the largest expenses on their balance sheet, their rent, their real estate, moving forward? We've got a client that is a producer for NBC, and talking with her, it was really neat. I saw like Al Roker on morning TV, and I was like, so are you sleeping in Al Roker's basement? Like, are there really people behind the camera? Like, I just imagined 15 people behind the camera as Al Roker's giving his morning spiel. And she said, no, I mean, they're in New York, right? The heart of it all. And it's really, right, Al Roker or whoever the host is in his or her basement, producing the show while the producers are all in their own houses, having chats and on their cell phones. It's really been amazing how much the game has changed. So one thing that we'll watch moving forward is global real estate forever impacted? Who knows what the long-term implications of that could be, but it's something that, analysts continue to talk about. Now, analysts, generally speaking, are wrong, right? You never really know. And I like to say every building I've ever walked into, it's more about the owner's pride than it is about necessarily we have this need. When you talk about, how fancy some of the buildings are and how extravagant, the glass windows and the fancy tables, right? All increased overhead expenses. It's probably more about pride. So we'll see how that kind of develops over the coming years. Are more meetings shifting to Zoom and so on and so forth. All right. So with a bright point in this is like intermediate treasuries, right? So we're going to talk about this in depth when we get into our bond conversation, but up 7%, right? Like everyone's like, why wouldn't I just put all my money there? We'll talk about that, but it's been a bright spot and something that we've learned and actually changed a little bit in our portfolios as we've gone through this based on some of the evidence, which we'll get into. All right. So part of the discussion and a lot of things that I keep hearing from people is how can the economy be increasing right now when there's so much uncertainty, unemployment numbers all-time high, restaurants are closing, Hertz is going under, Pier 1 Imports is going, like all these companies, like how is this even possible? Right. So the first thing I always like to remind them, and this is nerd talk here, right? But it's all about what you believe the price of a stock is. Okay. So we believe that the price of a stock is the discounted present value of all future cash flow. What the heck does that mean? Okay, so that means the price of the stock is actually all future growth. So what happens when stocks decline rapidly is all this uncertainty. I don't know if this company's going to be around. I don't know if there's all this future growth. I thought Apple was going to continue to produce cell phones and it was going to be amazing. Now all of a sudden, maybe people aren't going to use their cell phones, whatever it may be, right? Airlines are on this unbelievable trajectory. Now all of a sudden, are they going to go out of business? Are people even going to fly anymore? Right? All of this talk comes in, and now we start to question whether or not we truly had it priced in. And we didn't have a pandemic priced in initially. So now as we get a little bit more information, hey, the economy's opening up. These companies may not be opening up. These types of businesses may go under, but it looks like people are continuing to spend money. The world's maybe not as bad as it may seem in terms of financially. So we start to see the market increase, right? So it can continue to increase. The other thing is our government did a pretty amazing job getting cash out quickly. For all those that were able to take advantage of the CARES Act, the PPP, everyone got a deposit in their checking account if they filed, via electronic deposit. I mean, how amazing is that our government acted that quickly, was actually able to get through all the red tape and bureaucracy and do that and pump $3 trillion into the economy. Okay, so you've got this huge surplus of cash that's out there that now businesses and people, individuals, as we get a little bit more clarity, we can continue to go out and buy and spend things, okay? So that's kind of why the market's still able to increase, is because long term, we just didn't really know. Now we're getting a little bit more clarity. We could see a drastic, very quick rebound, but there's still a lot of uncertainty out there come third and fourth quarter as to unemployment and will companies rehire, will they not pay their rents, so on and so forth. So still uncertainty out there, but we're getting more and more clarity, and that's a lot of the reason for the bounce back. All right, so part of this discussion is why do I even hold some of these small value international emerging markets when the U.S. economy is doing so well, right? So, right, that makes up a big difference in terms of long term. So let's talk about equities. Equities, right, are stocks. So think stocks, equities, when you see that term. So there's our stocks here to date. We talked about that. Why even own some of those other ones, right? How about this small value in particular, right? This is kind of something that we are unique about, right? It's not going to be in your 401k, generally speaking. If you do, you only have 1 or 2%. It's typically not in your target date retirement funds, right? So why do we have such a tilt towards it if it's doing so poorly? So let's go back and take a look at the last 20 years. We'll look at large growth companies, think S&P 500 compared to those US small value. Okay, so it's pretty amazing, the difference in the results here. Over the last 20 years, from 2000 to 2020, you can see that the return has been more than 2.5% higher, although that standard deviation, that number on the bottom right, that means risk, right? So higher risk, right, which means bigger ups and downs of that portfolio, but a higher return. So you're getting rewarded for taking on more return, right? So if we didn't put it in there, right, it's like, well, I'll just get the S&P 500. However, if I do put it in there, I can increase my return pretty drastically. Now, we don't want to put all our money in there because it becomes too risky. So how does this play out over that last 20 years? You can see during those first couple of years, 2000 to 2003, think about the tech bubble bursting, 9/11 kicking off, right? Airlines, again, huge trouble, right? S&P 500 is going down. US small value is actually going up, right? So that's that discorrelation or uncorrelation in terms of the asset classes. One goes down, the other one goes up. That's good for the overall portfolio because it actually smoothes the ride. So it actually lowers the risk, even though we've taken on a little bit more risk in terms of a different asset class. So that was one good thing. Now look in 2008, right? The big market crash, the big recession of 2008. The S&P goes down, and this makes it look like a really small number, right? We see this drop. That's about a 40% drop. Small value, about a 60% drop, right? So again, more risk, bigger changes up and down. But if we hold on to it and we stay true to it, right, you could actually get a higher return. 2018, flash forward, again, fourth quarter 2018, Trump trade war with China, and then trying to raise interest rates. We see a big drop in the S&P 500, almost 20% right here, almost 30%, right, in terms of the small value. So you're going to see bigger ups and downs. But again, if you hold on it for long term, you're talking a huge difference in terms of your overall return in the portfolio. 2020, you can see again how drastic, minus 24% year to date versus minus 6%. But again, if we hold on to it, you can see that the change from 2008 to 2018 was drastic, right? Really big. Usually typically leads us out of a recession. It did in 2003, it did in 2008, it did in 2018, and it will again, we believe, in 2020. So a reason that we don't want to just sell it all, right? We're actually buying it, right? So we're buying the thing that's low, selling the thing that's high. Everything we know we're supposed to do, but we typically don't, right? This is why our portfolio is unique, and this is why we add value, right? We're adding value because almost no one has it in their portfolio. And so when we do, we're going to actually get a higher return without taking on as much risk. So that's great. That's the last 20 years. How does this hold up long term? Let's look since 1972. Again, blue being large growth, S&P 500, small, US small being that red. Again, another 2% difference in return over the long term, right? So there is reason that we put in some of those asset classes that may not be performing year to date as well. The long-term perspective of it is it's going to add value to your portfolio, right? Now we don't want to put it all in there again because that takes on too much risk, but the goal is let's add value to the portfolio. And this is one of the ways that we're able to do it. So that's just that small value. I pointed out because we're unique in terms of our own portfolios, but also because it was the worst performer so far year to date. But yesterday it was up 4.5%. About 2 weeks ago, it had a day it was up 7.5%. Both days the S&P was up about 1%. So again, we're not trying to time the market, right? We can actually get that higher return without market timing, stock picking, or using track record investing. We're going to follow the evidence. And so we don't do that. However, every time we see cash come in the portfolio, we're going to look out there and say, what assets on sale? US small value, let's buy some of those shares because they're going to go up over the long term. And if we look back 10, 20, 50 years, right, the difference is a couple of percentage points, right? Is that my idea? No, right? I wish I was that smart, but there are Nobel laureates that came up with that philosophy. And so we follow their evidence, right? We don't have to take on any of that unnecessary risk by gambling in the stock market, by stock picking, track record investing. So how about those other asset classes? We put them all together. Does it still make sense? So if we look at all the other equity classes, real estate, and this is just equities, just stocks. We start adding in international, emerging markets, international small cap. How does that do? Let's go back and look over the last 20 years. Again, a little bit more than a % of return. But if you look in the bottom right too, we also see that standard deviation, STDEV. That's the amount of risk that's in the portfolio. You can see it actually lowers the risk. So adding all those different asset classes lowers the risk and increases the return. And that's what we're doing for the portfolio, right? You look at the difference of $100,000 invested in 1999 all the way through 2019. You're talking about a difference of $100,000, right? And we lowered the risk by doing that, right? That's the value of diversification, prudent diversification, right? Buying the right things across the globe, staying true to it through the long term, through the market volatility. Again, this is an all stock portfolio. Very few clients are an all stock portfolio, right? You have to have extremely high risk tolerance, but I just want to talk about stocks in general and why we do that. Again, I wish that I was brilliant and came up with this philosophy, right? But we just invest with evidence, right? That's what we do. So Harry Markowitz, right, came up with the efficient market frontier. Burton Miller, Nobel laureate, Gene Fama, Kenneth French came up with the three-factor model. We use their evidence, their research, so that we can build the best portfolio at the lowest cost possible to get you that higher return. This is just us showing you the evidence and showing you how it's played out since 2018, 2020, 2008. All right, so how does it play when we look at the numbers? All right, so the S&P 500, $100,000 from 1970 through 2019, grew to about 15.3 million. You start adding in all the other asset classes, large cap value, small cap value, real estate, international, emerging markets, right? The difference of about 37 million. So that's a 10.6 versus a 12.6% return. Again, you're adding that the premium of the return by actually reducing the risk and coming up with essentially a higher return and more value to you. Okay, so that is stocks. That's what's happening in the stock market. That's what we're watching. Those are the things that are happening. How about fixed income? For fixed income, think bonds. Okay, real estate can also be tied into there, but think fixed income bonds. So bonds year to date. One of the biggest things that we've learned through this is part of this intermediate treasuries, and you can go back and look at the data again. There's a lot of evidence to support this, but you look at it year to date, it's up 7%. Why would that happen, Sean? Well, what's happening is people are selling their stocks, right? Everyone knows they're not supposed to sell low and buy high, right? And we don't do that, right? We're not doing that with our clients' money. But the rest of the world isn't as smart because emotionally it's so hard to block out all the noise. So what they do is they start selling all their stocks while they're low. They're locking in their losses. And where do they go? Well, they go to the good faith and support of the U.S. government, and they buy intermediate treasuries. So as people pour in their money, those treasuries go up. And so that's what we've really been seeing. What the contrary will be true. As the market increases drastically, those will not perform as well. Now, it won't be drastic, right? But there'll be decreases in that return as people sell their treasuries and go back to stocks. So they'll buy high. It's so hard to watch it happen, right? But the people sell low and buy high all the time when we all know we should sell high and buy low. International bonds up about 1.3%. Corporate bonds about 1.5%. Municipal bonds, right? Really, really hard to kind of get value there. And then global real estate, we kind of talked about that already. So what's happening with kind of some of the bonds out there and how do we kind of see this playing out in the future? So $3 trillion, right, of new cash from the government results in a really, really big bill anytime the government wants to raise the interest rate, right? So as the government tries to raise interest rates, they're essentially increasing their own cash flow problem because they'll have to pay the interest on that debt. So as we increase all this cash in the system, it may help keep interest rates low. That being said, we go back and look at history and some of the evidence. a World War II economy, a Civil War economy, where the government overspends, typically within the next 5 years, there could be a year or two of really, really high inflation. So something that we'll be monitoring, and something that could be really, really bad for people that say, I'm really scared. Let me just put all my money in my bank savings account. Let me have it earn 0.5 to 1% sitting in my savings account. You're lucky to kind of get that right now. But let me do that because I'm scared. All of a sudden, inflation rises, inflation increases, and that cash is losing purchasing power. So oftentimes what we do for our clients is we have that emergency fund set up to outpace inflation. It's got those intermediate treasuries in there. It's got a little bit of exposure to equities, so we get some stable growth. But the goal of that is to outpace inflation, right? Could be a really, really big issue and a really big problem if people have all their money sitting in their savings account. The other thing is out there is if people are looking for individual bonds, it's going to be really, really hard to find an individual bond with a good paying interest rate, right? Interest rates are down. And so naturally, companies are going to have a harder time paying out a higher interest rate to people if they can just go borrow money from a bank at a cheaper rate. So we could see bonds being affected long-term, buying individual bonds. That being said, in our portfolios, we're not investing for yield, right? Meaning we're not buying individual bonds to get this yield, right? We're actually getting higher dividends from companies, those small U.S. small value companies. A lot of the corporation stocks are paying higher dividends than individual bonds right now, right? So if we really wanted yield, we'd just invest more in stocks because there's a premium there. Ultimately, though, all right, bonds play a role of reducing the amount of risk in the portfolio, right? So one of the changes that we've made is we put more money in the intermediate treasuries in case of a fourth quarter drop. We don't know if we go out, we open up the economy, coronavirus comes back full force, we have to shut it down again. We want to be prepared for that drop fourth quarter, should that happen. Additionally, it's still a really stable platform no matter what, so it's not going to hurt the overall return of the portfolio that much. But it's one of the things that we learned through this is the intermediate treasuries have been strong. So how does this play out in the data? All right, so we go back and look at 2007 to 2008. Again, we chose that because of the Great Recession in 2008. You can see the red, right, being intermediate treasuries are actually staying very, very constant, actually increasing again. Why? People selling their stocks, running to something safe, buying treasury bonds. And so intermediate treasuries actually go up during that time frame. They remained very, very, very stable, right, throughout that time period. We see a 2018, again, fourth quarter 2018, big drop. Treasuries remain stable. 2020 comes along, big drop. Treasury actually increased by 7%, like blew our mind, right? A great place to have some safe cash is some treasury bonds. So again, that's in our emergency savings portfolio. But just want to show you how those treasury bonds react when we go through the Great Recession, the China trade wars, and then also the coronavirus. Remains really, really stable. All right, so how does this hold up and how does this play out versus other bonds? If we look at kind of U.S. and the total world bonds compared to the S&P 500, so U.S. large growth is in blue, you can kind of see just the 2008 to 2009 timeframe during the Great Recession. We saw the S&P 500 lose a ton of value, but we also saw treasuries remain constant. We did see a dip in total bonds, right? So again, we also saw this, as we'll show shortly, in 2020. Because the credit rating of all these companies was decreased, the bonds actually went down. So bonds and stocks usually react kind of counter opposite. Stocks go up, bonds go down, and vice versa. However, when we see huge recession type movements, we don't get as much stabilization from our bonds. Treasury bonds we do, world bonds, corporate bonds, we really are not seeing that. So this is one of the things that we said, hey, this happened in 2008. It happened again in 2020. Maybe we should have a little bit of a shift in our portfolios. And so we've made that change just in case of a fourth quarter recession or another fourth quarter drop if coronavirus comes back hard. How does this play out? 2018, 2020, you can kind of see very end of this chart here. In 2020, corporate bonds in yellow decreased intermediate treasuries actually increased while the S&P was decreasing. Okay, so again, we rather have that stable platform. And then we're not doing it for yield. Again, we're doing it so clients stay invested, so that the fear doesn't kick in and say, maybe I should run to cash, right? We want that stable platform, smooth out that roller coaster, because if we can do that, we can maximize your return, right? And that's really all we're trying to do, right? Put you in a portfolio that makes sense for you, use the evidence to get a higher return, and then help you stay disciplined along the way. Courses like this webinar like this is there to kind of inform you so that you know what's going on, know what we're thinking, and showing you how we are providing value to your overall investment performance. And again, I wish I was the creator of all this, but all we're really doing is investing with evidence. So how does investing with evidence look in our portfolios, right? So we've done about 3 of these now, and I thought it was pretty neat to kind of go back and look at how things have kind of progressed over time. So our conservative portfolio, think about that emergency fund, targeting, a 3 to 5% return is what we're targeting. Conservative in 2019 was up 10.5%. So a really, really good year in 2019 for all portfolios. However, we did this presentation at the end of March, right? Almost the worst time of the coronavirus recession. It was down 5.3%. So just outside that lower limit of what we should expect, we had kind of reached it. Looking back the last 6 months, it's down 2.6%, right? So again, stable platform, 10% in 2019, down 2% year to date. I'm sorry, over the last 6 months. And then ultimately the target on this is about 3 to 5%. You can kind of see the drop, the range here in the chart. Our moderate portfolio, up 16% in 2019. Again, a phenomenal year, not normal, right? Kind of the upper range of what we'd expect, targeting this portfolio between a 5 to 7% return. That worst time period that we looked at in mid-March was down about 11%, right? So again, outside of a normal probability, right? A recession is not normal, right? So outside that normal probability, over the last 6 months, as of yesterday, down about 6.5%. Okay, so again, still in this range, but overall, it's still doing exactly what it's supposed to do. This virus, this recession, this economy is not completely out of the ordinary, right? We've seen these things multiple times in the past. Our growth portfolio up about 20% in 2019 during the coronavirus recession, down about 13.5% over the last 6 months, about almost 9%. So things are working back to where they should be, getting closer and closer. That's why we're going to stay disciplined, stay through it. Aggressive portfolio was up 23% in 2019. It was down 23% during the Great Recession, the coronavirus recession. And then the last 6 months down about 11%. So what that shows me is the equities are really coming back strong. Okay, we've seen huge changes, big ups and downs, right? And that's why this portfolio isn't for everyone, right? You've got to really be willing to stay invested during this time period if you want to be a part of that portfolio. That portfolio we're talking about a 9 to 11% return, but it comes with a lot of pain, right? You've got to be willing to stay disciplined during some of these huge swings, which is not easy. And I'll tell you, it's amazing when we talk with clients, we go through the risk tolerance questionnaire to make sure we put them in the right portfolio for them. We go back and kind of show them historical returns and say, hey, in 2008, that aggressive portfolio was down 40%. Could you stay invested? And everyone's like, oh yeah, no, yeah, I did, no big deal. And then 2020 happens, and it's like, wow, man, that one hurts. So going through it is so much harder than looking back on it and being like, oh yeah, I could do that again. Yeah, no big deal. I'll stay invested. Right? Emotionally, it's just so hard. And for me, right, it's hard because I know that it's so important for me to help you achieve your goals that I want you to stay disciplined so that we can get the returns that the evidence says that we should get, right? So at this time, I'm going to kind of open it up for questions, see what you have, and we'll go from there. All right, so one of them is expand a little bit on real estate, specifically investing in commercial real estate. Do you recommend including this in your portfolio? So I will tell you this. It is in our portfolio a very small percentage, right? Of our overall equity portfolio, if it was just equities, it's only about 5%, right? So it's there as a diversifier more than anything. to go out and buy individual commercial real estate. And this is where being with a fee-only advisor like us is drastically different than working with, you pick the firm that sponsors a PGA Tour event. But most people get invested in commercial real estate by buying individual REITs or real estate investment trusts. These are huge scams, and it really, really hurt people. Everyone that I've looked at over the last 10 years is just a really, really bad investment. And the reason that they buy them is because some financial advisor is making huge commissions on it, like 10% commissions. Sell a client $50,000, privately held real estate investment trust, $10,000 for the advisor. It's the biggest slime ball move in the game. The value of your portfolio on your statement looks like it's high. If you ever try and sell it, you really can't. It's really, really hard. So real estate in general is a very, very different asset class. And most of the time what happens is the commissions, the transaction costs erode the value of the investment. There are so many people that are involved. It's illiquid. So you can't just buy and sell it whenever you want, right? You've got to hope for a liquidation event. Those types of things make an extremely risky asset class. That's why it's such a small part of our portfolio. Buying it through a broker is dangerous. And if anyone tries to sell you one, you're working with a slime ball. But just generally speaking, it's a good diversifier, not something to go throw a whole bunch of money at this time. Good question. Do you expect the uptick around U.S.-China trade war conversations will have a large impact on the market as it did in the fourth quarter 2019? Don't know about as large. So there were kind of two phases to the trade talks. Phase one we completed in 2019. Again, part of the reason that we had such a good year. Towards the end of 2019, kind of got the first part going. Most of the heavy lifting, though, was waited for phase two, which was supposed to happen this year. Coronavirus kicks off. Not the best of times. I think there's a lot to be watching with U.S.-China right now. The way that China is treating Hong Kong, a lot of, essentially taking away a lot of the freedoms that they were promised. Two countries, one China is now going to one China all over the place. That will have an impact. There is so much in terms of intellectual property discussions between some of China's. It's really a matter of national security, about the technology and what's in technology between the two. So I think there will be continuing ongoing discussions. To be really, really hard to kind of bridge the gap between the two. We've actually exiled some of the companies from our exchanges to not even be allowed on our exchanges anymore. So I do believe it'll be something to watch. If we weren't an election year, if we weren't in a coronavirus year, if we weren't in a Brexit year, it would be much easier to kind of differentiate between what's happening in the markets, how much it's related to U.S.-China trade war. But any time that there is going to be animosity between those two countries, I would anticipate movement in the market. Long term, right, which is really what we're doing, investing with evidence, U.S. and China are going to do business together, right? The world needs it. We need it. They need it. We will figure it out eventually. I believe in our U.S. government. I believe in the Chinese government to be able to get a deal done that makes sense. Long term, everything will work out. We'll all be better in the end, but we will see some pain movement through it. Any other questions? Awesome. So thanks for everyone for joining in. I know I got a little bit nerdy today, but I do love this stuff. And I wanted you to just kind of know what's happening in the market, kind of block out the noise, look at the evidence, and kind of realize what's happening inside of the portfolios and know that, hey, everything's going to be all right. If this spurs up any individual questions, reach out to me. Be happy to kind of have a discussion at length. But, hopefully this was informative to kind of know what's really happening in the economy, give you an opportunity to kind of see what we're thinking here, at Bolton and Endeavor. You guys enjoy the rest of your week. Have a great weekend and enjoy some sunshine.
you.